I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for InstitutionalAdvisors.com. Welcome to the show, Bob.
Good morning, Jim. Good to be with you and our listeners.
Interesting numbers for the week. Oil was above $50 for most of the week, the first time it's been that high since about a year ago. Down a bit. Is this a natural correction?
Yeah, it got trashed all the way down to $26 in January, and at the time we pointed out that it was at the time of year when you could have a seasonal low, was exceptionally oversold, and our target had been 27. So, anyways, the rebound carried just pure energy, technical bounce, and up to around here you can have a pause in the advance in crude oil. I think it really got overdone, and it's been down ticking the last couple of days. This was against the U.S. dollar, which had bottomed a while ago and then recovered, and then had a sharp setback here beginning last week. And then in the last couple of days, the U.S. dollar is firming up. Our case is that the U.S. dollar is going to firm a lot more than it is now. But we were into this line that we've used, Jim, from time to time, the all-one market, where everything was moving as if in concert, because you would have the dollar down, crude oil up, and stocks up, junk bonds up, and the long treasuries down, and that was in lockstep, and it just got carried away here quite a bit. So I think this is the start of a pretty good correction in the crude oil, and you'll remember that our work on base metals back in December, January was looking for a low there, became very oversold, and the base metals index, the one we look at, a symbol is GKX, it rallied smartly up into March, April, and then it's down in copper, which got up to 220, is actually it was 230 on this contract I'm looking at here now. And it's now down to, well, a couple of weeks ago it got down to 205, bounced up to the 215 level, and that was last week, and then zoom, right down to 202 here this morning. So, and the low in the disaster in January was 195, so that's pretty cheap. A lot of it is to do with the problems in China, not consuming as madly as the country was, probably long too many things. And then there were a lot of traders and investors around the world that didn't anticipate that hit to base metal prices. And their world is that, well, there's the demand and supply and all that sort of stuff. And it was quite offensive that it fell so far down to the 195 level. So then when it gets up to the 225, 230 level, it was, oh, this is where it should be, and it'll go further, but it's headed down. And the one hot commodity here now is the soybeans. And when you put it in the index for agricultural commodities, the GYX, it's had a terrific rally. It's just, the last week of trading has been virtually straight up. So it's now up to very overbought and generating other technical things, upside exhaustions and everything else. So we'd expect this has been the last hot sector. The the rotation we were looking for back in December, January for most commodities would be to bottom around then and then rally out until the spring. The last one to be hot is probably the last one to turn cold, and it'll roll over. So it's interesting. This has been a setback in crude oil the last couple of days has helped the bond future. We look at it on the ETF, the TLT, and it's back up to that high of earlier in the year at the 134 level. It looks good. I think it could go a little further yet, but one of the things you've got going on is extraordinary financial markets in Europe, where the Draghi, the central banker, has been extremely ambitious in buying bonds, and this week they started a program to buy European corporates. And we want to back up here a bit here now and review why the central bank have been so aggressive, and it's that they have a theory that if you put credit into the economy, it'll drive the economy up, and that, as we've explained for a long time, just doesn't work. So they're now beginning to realize it doesn't work. So then they're trying to get consumer price inflation going so that people will buy more things, and that's not a big deal. So then their hopes are resting on increasing asset prices in like stocks and bonds, and that this will then have the magic needed to get the economy going. But they really don't understand how financial markets work. They don't understand how commodities work. They don't understand how the economy works. They're living in a world of theories. And the most exciting thing now, other than watching some of the price action, is that this theory is really stalling out. And this week, a study was released by Deutsche Bank, one of their top economists, and is just pointing out that to their economist friends at the European Central Bank, it isn't working, and it's ruining the commercial bank business. You take a look at Deutsche Bank stock, DB, it's been a disaster. So, it's a very interesting to see a very well-reasoned criticism come from a commercial bank of the foolishness of these central bankers. So everything is fine in this so long as the price is up. Now, the prices that have been up, crude oil, seems to be stalling out at about the right time. Base metals, they're over their history. And the other industrial commodity, lumber, had a very good high with good technicals, and is probably starting a cyclical bear market. It's put in a cyclical bull when it got up to 330. So the last set that has been hot been the grains, and they're now hot enough to roll over and die. So this is going to really upset the central bankers, who they have to have inflation. Otherwise, they're just paranoid about deflation. And the other problem you get is if you get trigger off, you get enough asset prices going down, then they can't get their portion of credit expansion out. It's the old saying from the 1930s is they end up pushing on a string, and I think we're about to get into that. So, Jim, we live in interesting times.
Well, our correspondent in Japan, James Corbett, will do a story for us on This Week in Money about how the biggest bank in Japan has done one of the most shocking things they have heard in decades, and that is they are now refusing to sell government bonds because they have negative interest rates. Who wants to buy something that loses you money?
Right. Yeah, so an old saying in logic, the reductio ad absurdum, where you take a person's point and stretch it to it appears to be absurd. And you and I could have argued this a few years ago, that they were going to stretch their own ideas to absurdity, and with negative interest rates, they are at the point of absurdity. So, again, the point I want to get across here is that, it's an old saying I remember from the old Vancouver Stock Exchange. So long as the price of the stock is going up, the people will believe the most preposterous stories. And so here we are now. Credit sort of is still expanding. You've had a nice rally in commodities. So the prices are going up, and people are believing the most preposterous story is that the central bankers have got it fixed, and all of their hands-on stuff are going to work. You've got many financial institutions out there that still believe this, but then you've got others who don't. And there's the smart money indicator, and the smart money's been selling. But there's been articles from time to time that the central bankers have been buying equities. So if you take a look at the behavior of, say, the S&P relative to the whole New York Stock Exchange composite, the S&P and the Dow are very close to making the highs of last year. The NYSE composite is nowhere near that, nor are the rails, nor the banks. So then, if one turns loose one's paranoia, which I like to do from time to time, the central bankers, it's well reviewed that they have been buying equities. So what equities would they buy? Dow Jones and S&P type equities. So this is why you've got the central bankers bidding the senior indexes up almost to new highs when their earnings have been deteriorating awfully. The quality's bad because they've been jacking around with buying the stock back, individual companies on the S&P, to make their earnings look better. Their earnings are deteriorating, so it's totally insane, and it won't be seen to be insane until we're on the next leg down in the senior indexes. But in looking at the pattern of the last couple of weeks on the S&P, it looks like a false breakout. And that's kind of a dangerous sign. And within this, you've had the NYSE comp make it up to the moving average, 65-week moving average, that has turned back previous important rallies. So our theme on the stock market is that this has been the second big rally in the bear market that started a year ago. And it is similar to the second big rally in the bear market of 2008. And these moving averages were important in turning back rallies in 2008 and on things like the bank stocks, broker-dealers, XBD, and the NYSE comp. These moving averages are holding the rally here now, preventing it from going further. So if this weakness today continues into next week, we'll be looking at very interesting times where the great theories of the central bankers, this time on another decline in stock markets, that's going to really demolish the regard that these silly central bankers are able to maintain. So this then gets us out to what's happening in gold and silver. As an alternative investment, they've rallied here recently, and they've even up a little bit today against a firmer U.S. dollar, but that's sort of like old. The new will be a firmer U.S. dollar. And we had a terrific rally for the sector. It outperformed anything. You had the Hoye index of senior gold stocks rallied from 99 in January to 236, I think the high was, and it's been trading around that high since. And our monitor on action in the precious metal sector is that when you're in a rally for precious metals, silver outperforms gold, and when the silver people get really excited, it's usually danger, and we like to measure that. And when the RSI on the silver-gold ratio gets up to above 78, you're in a quite a speculative froth. And this one, it had a close of 80, which is high. So that suggests we're going to get a tradable correction out of the precious metal sector. We've been advising, traders to take some money off the table, and investors should take some money off the table too. It's been a brilliant winter, and one might just as well go, take some money off, and there'll be new stories, or there'll be the same good stocks in the gold sector that you can buy at a better price somewhere over the next few months. So, but of course we can't pinpoint that month down, but we'll be watching for it.
We'll have more with Bob Hoye right after the break.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. The latest jobs report came out for Canada and the U.S. A different situation in Canada than the U.S., where they only created 38,000 jobs but lost 176,000. Canada's net gain nearly 14,000 jobs, mostly in Ontario and Quebec. But Alberta, the natural resource sector, really being pounded. Canada has now lost more than 1 in 10 natural resource sector jobs.
Oh yeah, that's specifically for the resource sector, and the numbers you mentioned were Alberta, and but you've got regular base mining operations have been reduced, or some mines actually shut down. So it's not good, and it could spread to other things, because you've had a terrific party in buying cars, new cars, and second-hand cars, and on time. We heard one here in Vancouver on the radio, news radio, an advert to buy a new Maserati for $89,000 Canadian, and you could buy it with 1.9% interest and over 39 months. And I thought, gee whiz, are people on a tight budget reaching up and buying Maseratis, high-end car? Mind you, I did phone the Maserati dealer and talk to a salesman there, and that $89,000 Maserati is their base one. It doesn't have all-wheel drive and a number of other goodies, but they are, a very exciting car. Price seems right for me, but it is an expensive car, and you think people with money, need not have to finance it. So it's curious on that one. So car sales are slowing down. You've had the real estate bubble in Hong Kong peak in August. Remember, the Shanghai market peaked in June, and they're declining. You now have the hot high-end real estate market in Manhattan continued until about 3 months ago, and now it's suddenly turned into hey, there's a whole lot of product here. And then I just read one this morning in London, England. All of a sudden there's a lot of excess capacity in apartments there, new stuff coming on. So we're seeing this on the real estate side as here's another asset class that is no longer going up. And we always want to remember that in order for the Federal Reserve to be reckless, it needs reckless speculators out there. Then the other part about cars, or the ordinary cars and all that sort of stuff, is that the aggressive buying in the sector and aggressive financing is similar to what the folks were doing in the U.S. with house prices back in 2005, 2006. It was Katie by the door. I got to own this, and and the lending agencies were providing 125% of financing, and all was wonderful until it went bad. So here you have something similar going on in cars. It's not aggregate as big a story, but it is the dynamic story, and it's likely beginning to fail in here too. So I hate to always look at the bleak side, but these sides have been very strong and only recently turned bleak. So we're just reporting on it.
You can put Miami in with that list with a downturn in condo sales as well.
You've seen one there too.
Yeah. So how soon before this hits Vancouver?
Yeah. Oh, eventually it'll get Vancouver. Because if you're Asian, now they looked for a residential real estate housing index in China, and I'm not sure the reliability of it, but it had been going up for the last number of months when the Hong Kong market had been going down. So it looks like if some Chinese cities have had rising residential real estate prices, it can't stay up there on its own for too long. It was like Manhattan. It can't stay up there. It couldn't stay up there on its own for too long. And even London, too. So this is very exciting times, Jim.
Bob, thank you very much for chatting with us.
Well, good to be with you, and we look forward to our conversation next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. If you have any questions for Bob, you can email us at info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.